Did you enjoy your break last week?
Yeah, you feel better?
Get,
Did you have the flu?
getting there? Yeah. It's the first time I've had the flu. I can't remember. I mean, I can't remember the last time. But yeah, that took me down hard. I mean, there were like 4 days there. We're sitting up in bed. That was my major goal for the day, was sitting up. Yeah, it was rough. I'm doing great. How are you? Hey, you're looking good. Yeah. It's Tuesday. Dress up. Wear a suit Tuesday, okay? I didn't get the memo, but next time, looking pretty snazzy. Now, you're not comparing to him, but you're still looking pretty good.
He had me last week. He had
Okay.
me last week, though.
All right, let's attempt to have class today. You know, after one hard week of class, I decided you needed last week off. So I went ahead and sacrificed myself and decided to come down with the flu so you could have the entire week off. I got that out of the way. Okay, I will tell you it was kind of touch and go there for a while. I didn't know whether I was going to make it back this semester for you, but after about, well, a literal week of feeling terrible and having some days where sitting up in bed was my major accomplishment for the day, literally was sitting up in bed. That was the sickest I've been in years. And so whenever they tell you, wash your hands, use your Germ-X and all of that stuff, they are serious about it, okay? I can tell you it is no fun to be that sick. But hopefully that is past. I've just got a little bit of a cough left, and so what we're going to do is kind of force me. I've taught this class enough that if I do have to miss class, typically I've got a class recorded of that material. And so what I did last week on Canvas was under the integrity recording section, if you go here, and once it brings this up, you're going to see, now this is our first day of class going over the syllabus. This is the first chapter that we covered in class. Now, if you go here to additional content, which most of you have probably already found this, you're going to see chapter 1 again. So chapter 1 here is split into 2 different sections. The reason I did this, so part 1 of 2 and part 2 of 2, this is because of the high-pitched sound that's coming through the integrity recording, which I know is driving some of you crazy. So I'm hoping that we have this fixed today. Well, I guess I'll know after class is over with, but we were in here working on it yesterday. So that is just the same thing that we covered in chapter 1 previously. And then this is chapter 2. So chapter 2, part 1 of 2, and part 2 of 2. You need to look at these on your own. We're just going to talk about chapter 2 very briefly today, and then we're going to move on to chapter 3. So when you get a chance, take a look at this. This will be on the first test. So we've covered chapter 1. We've got chapter 2 there. We're going to spend a couple of days at least in chapter 3. And then we'll move on to 4 or part of 4. And then we need to start thinking about a first test date, although that's still quite a ways in the future, okay? Also, we'll have a first quiz probably fairly soon. So by fairly soon, I mean whenever I find time to put it together and put it on Canvas. I will let you know. Typically what I do is I have about a 3-day window for you to take the quiz. Normally there are 5 to 10 questions, so it's going to take you 15 minutes to take the quiz, but I want to give you plenty of opportunity to take it in case you're really busy. And also, normally what I do is I allow 3 opportunities to take each quiz with the highest score counting. And by then, after taking these quizzes 3 separate times, if you still haven't scored 100 on it, come see me, okay? We need to go over some things. All right, so are there any questions? I know missing the second week of class is not the perfect way to start out. It's not what I had planned, but it's just what we were dealt. Oh, also I sent an announcement out through Canvas today that if you happen to be looking for a part-time job, I don't know how many positions they're going to have or exactly when they're going to start, but the Murray Bank is accepting resumes. So if you are interested in a part-time job, you need to send your resume along with a class schedule to hr@themurraybank.com. So again, you're not going to get rich, but it's really good experience. Sometimes if you're a finance student, sometimes we can work it out where that part-time work counts as an internship opportunity, so you get up to 3 hours credit for it. So again, if you're interested in that, you can contact them, you can contact the Murray Bank, or you can contact me. I'll be happy to talk to you about it. All right, now last week, you've got a recording of chapter 2, so it goes through this. I mean, there's a couple of hours worth of recordings on chapter 2. I wanted to talk just about a couple of things regarding chapter 2. This is still just kind of the introduction stage of the class, but it talks about the operating environment of a corporation. So what do corporations deal with on a daily basis? So primarily in this chapter, it talks about financial markets, which I'll let you take a look at that on your own. It talks about financial institutions, things like banks, insurance companies, credit unions, mutual funds, that type of thing. It also talks about income tax. And so let me move down to the income tax section. Okay, now the reason that we spend some time talking about, and we're going to talk about this from a personal perspective too. One is it's tax season. And any of you who have had a job and have paid either federal income tax, federal personal income tax, or maybe state personal income tax, or sometimes they have local income taxes. Corporations also pay federal tax, sometimes state taxes, sometimes local taxes. So it's something that you need to at least understand. I don't expect you to be a tax expert. If you want to learn more about taxation, you can take Accounting 302. You will learn more than you ever wanted to know about our income tax system in Accounting 302. But this is just something that I think every person should be aware of. And the reason it's important is because you're electing people to Congress who set the tax laws. They vote on this to determine how much in tax of your income do you pay, or how much does a corporation pay. So again, it's something you should at least have an opinion on. Now, corporations, as I said, just like individuals, pay income tax on their earnings. Now, in the United States and in most other countries, we have what's called a progressive income tax system. Can anybody tell me what that means, if we have a progressive income tax system? Okay, so that's exactly correct. Somebody want to add to that? Does see another hand go up somewhere? Are you wanting to raise your hand, or are you just scratching the back of your... Okay, okay. It's dangerous to make those moves, okay, in class. Okay, so with a progressive tax system, you've got a layered system, and we'll see that in just a minute. But what it means is the more money you make, the higher the percentage of your income you pay in income tax. So the more you make, the larger percentage you pay. We'll come back to that in just a minute and talk about the fairness of that, and if you think that's a just and fair system. Now, there are some other possible tax systems. What are some other possible tax systems that we could at least theoretically have? What a flat tax? What's a flat tax? Okay, so a flat tax means everybody pays 10%, 8%, 12%, whatever it might be. And typically, with most, during most presidential elections, there will be at least one candidate who is running on a flat tax system. So they're saying, look, we need to simplify our tax system. It's too complicated. Everybody pays 10% of their income. That's it. You make $100,000 per year, you pay 10% of that, or $10,000. If you make $10,000 per year, you pay 10% of that, or $1,000. And that's simplifying it to the max, okay? That has an appeal to a lot of people because most people do not understand our tax system. How many of you do their own income taxes? So some of you do. How many of your, if you know this, how many of your parents do their own income tax? Okay, so several of you. Now, what tends to happen is when it comes to income tax, especially personal income tax, is when you first start working, normally you can get by with filling out what's called a 1040-EZ. And that is a really simple tax form. It takes about 10 minutes to fill it out. And normally, you're going to get, as a college student, you're going to get most of your tax that you paid in back. Sometimes you might get all of it back, which is a great thing, okay? But as your income starts to become more, and it starts to become more complicated, so maybe you've got income from other sources besides just a job. Maybe you have interest income. Maybe you have dividends from stocks. You might have some capital gains income from buying and selling stock, or maybe buying and selling property. And so as it gets more complicated, what most people do is they simply pass it off to an accountant. And they say, look, I don't know what's going on. I don't understand this. I'm more than happy to pay you to calculate this for me. Okay, now I am one of the foolish people who continue to do my own income tax. But I will be honest with you, it gets more difficult every year. And it seems to take longer every single year. Now, I'll admit, I'm not the sharpest knife in the drawer, okay? But I do have some experience with financial matters. I do have some experience with accounting. And I'm thinking that if somebody with a PhD in finance is having a struggle with calculating their taxes, most other people are probably going to have a struggle calculating their taxes. So a flat tax would be just so much easier. The problem is voters don't necessarily like a flat tax. Now, there's also something called a regressive income tax system that we could have. In a regressive tax system, that's a theoretical tax system. We're never going to see one, but what that means is the more money you make, the lower the percentage of your income you pay in taxes. All right, now let's step back here to the progressive tax system. As any of you who have paid tax know, that's not really a fun thing to do. I mean, yes, it's patriotic. We all should pay some tax. I mean, let's take a step back here. What do our taxes pay for? Infrastructure, like what? Roads, okay, good. What else? Okay, so there are unemployment taxes. That's a little bit different than income tax, but unemployment. Schools, so this building that you're sitting in, these nice cushy chairs that you're sitting in. What else? What? Okay, so national defense. Okay, that's a good one. What else? Social Security. So that's part of a tax. That's a little bit different than excuse me, income tax, but is still looked at as a tax. Now, let's take a step back here. Somebody mentioned national defense. How do you divide up national defense? I mean, should somebody be protected more than somebody else? Let's take me, for example. I don't know any of you in terms of what you make for a living, how much money you make, okay? I'm assuming that if you're a typical college student, you probably don't make just a lot of money. This is how it is when you're in college. You tend to be poor. That's how it's supposed to be. So I'm assuming that I make considerably more than most of you for a living. And I probably pay a hell of a lot more in income tax than most of you do. So should I be able to say that since I pay 5, 10, 15, 20, 30 times more than you do in income tax, that I should be better protected by our national defense than one of you? Is that a fair assessment? No, it's not. You can't do that. You can't say, okay, we're going to protect one person over another. It's just the national defense. So we can't break it up. Now, in looking at a progressive tax system, even though I'm paying more in terms of national defense, I don't get any special treatment. What about in terms of public education? Let's say if I make more than somebody else, or let's say I make less than somebody else. So I make less, I pay in less in taxes. Should my children get a worse education than somebody who pays in more tax than I do? No, it's public schools, okay? You're sitting here for a reason, and different reasons. Some of you are sitting here because your parents said you have to sit here, okay? It's like you either go to college or you go to the military or you go to work, okay? One of those three items, and you decided sitting in class was better than the military or working full-time. Others are sitting here because you're paying for it. Maybe you've been out and worked at a job you didn't necessarily like so much, so now you're coming back to school to get more education so that you can do something else. But I think that most of you are here for at least part of the reason is because you want to make a better living than you could have without a college education. Is that fair? Is that a fair assessment? You know what that means, don't you? When you make more money, you're going to pay more income tax. Some of you have friends who decided not to go to college. We've all had friends who decided not to go to college. And you might have graduated with that person. You've been out of school now 2 or 3 years, possibly. They decided college really wasn't for them. They went to work full-time, maybe at a local factory. And that local factory pays pretty well. And so they've been working 40, 50 hours per week. They make what they consider right now a pretty good living. Possibly they have their own house. They might be driving a new car. They might be taking vacations that you can't afford. And they're doing a lot of things with money that you simply don't have right now. But you're sitting here for at least 4 years. Now, 20 years from now, 10 years from now, as your pay goes from, you graduate from college, maybe you get a master's degree, and your pay goes from 50 to 70 to 80 to 100 to 130,000 per year maybe. Maybe your friend who started at the factory 10 years ago, 15 years ago, 20 years ago, they're still going to be making approximately the same amount in terms of real wages. Now, is that fair or is that an unfair tax system? And the great thing about this is there is no right or wrong answer. It's simply whatever you think is fair or unfair. So is a progressive tax system fair to our society? Or does it possibly punish us for being successful? And this is what you should have an opinion on. You don't have to have all of the answers, but you should have an opinion on yes, it's fair, or no, it's unfair. So let me hear some of your comments on this. Typically, we can get some pretty good discussion going on this. And let's all remain civil, okay, as we discuss this.
I feel like if you go to school for 4 years and you paid out all the money that you go to school for, I feel like the government should kind of get more attention to taxes, but I understand why they school, then you eventually have to be paid with school taxes or back, you know, your financial aid back. And then if you make a lot more, they'll take out more money, so it just takes longer to pay back to you.
Okay, so you're saying you think it's sort of, it's a little bit unfair for those who maybe work hard and try to be successful. Okay. Somebody else? Agree, disagree, have some other comments on this? You're the ones who are going to be paying these taxes. Again, you should have an opinion on this. So is it a good or a bad thing? And I've heard all of it, okay? So you're not going to say anything that surprises me. Okay, so if we have a flat tax system, which, or you're saying that would be more fair than a progressive tax system? Okay, but it might not, it might not raise enough money for what we spend our money on. Well, let me ask you this. Is the United States at spending their government money? Are we good at that? Are we really efficient? We're terrible at that. If you or I ran our financial lives like the United States government runs their financial life, we would be bankrupt. Okay? We'd have everybody suing us for something. Because if we make a certain amount of money, we have to live within those boundaries. If the United States has a certain amount of tax income rolling in, which that's what our taxes are for, is to pay for the stuff that the government uses, we can spend that, plus we can spend a whole lot more. And that's something that we've been doing. I mean, that's not a new development. We've been doing that for years. But it's something that's going to have to stop eventually. And that's kind of the scary part. Because at some point, somebody's going to say, that's enough. We're living outside of our means. We have to cut back. We have to cut back on the services that we provide our citizens. And guess what? You're the people that we're going to start with. And that's going to hurt a lot when that happens. Now, I'm older than you, okay? So maybe I'll make it through before they start that process. But whenever it happens, it's going to be a big shock to us because we're used to, in the United States, just basically spending whatever we want and not worrying about the consequences. Now, think about this for a minute. When it comes to a progressive tax system, a couple of you have said it's fair, some have said it's unfair. And I'll kind of give you the basics of why we have it or why some people don't like it, okay? And again, I try to stay as neutral on this topic as I can. Okay, as you hear me talk about it, you probably pick up pretty easily if I think it's fair or unfair, but I try to stay as neutral as I can. People who say this is a fair system, they say that when it comes to living, there are certain expenses that we have to pay. Food, shelter, clothing, we all have to buy those things. And so if you're making $20,000 per year, the majority, if not all of your income goes to food, clothing, and shelter. If you're making $120,000 per year, you're still going to pay for food, clothing, and shelter, but you have more what we call expendable income. So this is extra income that you have left over that you're not spending on the necessities of life. And so the thinking is, if you've got some excess money, then you can help out those who don't make as much money as you by paying more income tax. Right or wrong, we can vote representatives to vote on tax laws, but basically we have to play within the laws that we're given. And I can say, I don't think that's fair. What about a medical doctor who goes to school for 10 years? They get out, they're making $500,000 per year in income. And they're paying 40% of that in income tax. Is that simply punishing someone for working hard or for being successful? Or maybe a small business person who builds their business up through 60, 70, 80, 90-hour work weeks. And now they're having to pay more because maybe somebody just doesn't feel like working. I mean, believe me, last week I did not feel like working. Okay, and I was fortunate enough that I could get paid even though I wasn't working. But I think all of you know members of our society who they just don't feel like working. They don't ever feel like working. And as long as the government will pay for their food, clothing, and shelter, they're not going to work. Is it right? Probably not. Is it something that we deal with? We have to. Now, the argument for the progressive tax system is, as we talked about earlier, their basic necessities of life have to buy. Some people are simply too sick, as I was last week, or maybe they've got a permanent type of disability, or they're simply too old to work. And so I think it's very fair that we take care of those members of our society. I mean, you don't want to be 80 years old and trying to go to work every day unless that's your choice. So when it comes to paying for those individuals, I think most of us think that's perfectly okay. Now, here's what decides this type of tax system we have. It's down to this. If we broke our voters down into low income, middle income, and high income voters, which of those makes up the largest percentage of voters? Low income. And the people who are considered low income, how much of their income do they pay in taxes? Very, very little, if any. So if you're not paying taxes, are you going to vote somebody into office who's going to raise your income tax? If right now you're not paying any income tax, and you've got maybe a government subsidy coming in each month, life's pretty good right now. You don't want to change that. And so, I mean, we can talk about fairness and who's being helped, who's being hurt, and we can talk about, we could spend an entire semester on this topic. But the thing is, if people are happy with the way things are being run and they're getting by, they're not going to change it. It's as simple as that. I'm not saying it's right. I'm not saying it's wrong. It's just, it's not necessarily changing a tax system. It's more of changing a mindset. And that's tough. That's hard to do. If you want something, you have to work for that. I think most of you understand that because you're here. Okay? There are a lot of people who don't understand that. They've never understood it, and they're probably not going to understand it, right or wrong. Okay, so individuals, corporations, the more you make, the more you pay. Now, a couple of different types of income here: ordinary income, capital gains. These are all treated the same for purposes of this class. So if you're going to calculate income tax, which you will be asked to do on the first test, then each of these are going to be calculated the same. And if you take a look at this is called a corporate tax table. And so what this is, you'll notice we've got different levels of income here. So for example, we've got, if your income is over $0 but less than $50,000, you're going to pay 15% tax on any income that you make. If your income is between $50,000 and $75,000, what we have here is a base tax. So what this table is supposed to do, it's supposed to make things just a little bit easier for you. Now, for some students, I think it maybe complicates the matter. But if you make between $50,000 and $75,000, you're going to pay $7,500 as a base tax, and then you're going to pay 25% times any amount over $50,000 up to $75,000. Then you're going to jump to the next highest level. So what you will notice is, notice the tax rates here, 15%, 25%, 34%, 39%. Notice that these are increasing. This is our progressive tax system at work. The more you make, the larger the percentage of your income you pay in taxes. Now, if you take a look at, at this, you're going to look at this and say, well, wait a minute. Now, here we're dropping down to a lower percentage. Well, actually, percentage-wise, total percentage-wise, the base tax makes up for this. So you're not actually paying a lower percentage in taxes. It just looks like it when you look at this 34%, but actually you are paying more taxes up to, and this one goes up to $18.3 million. Now, some people will say if you make $18 million per year, you should pay a lot of your income in taxes. But, and you could afford it, but I'm thinking if you did something to create a living that pays you $18 million per year, you should be able to keep a lot of that because you've probably done something pretty fantastic, unless you just happen to inherit this money by doing nothing. Then of course, then you've got to kind of, how do you break that down? So a tax system is a very, very complicated system. Now, here's an example. You need to be able to calculate taxes using this table. So let's take a look at this example. It says, using the table on the previous slide, here's a calculation of corporate tax. So let's say that your net income is $8 million. And the question is, simply calculate the taxes that you would owe on $8 million. Well, I'm going to jump back over here for just a minute. First of all, we're going to find where do we fit in this table. So $8 million fits in the $335,000 to the $10 million category. That's a pretty wide category. And it says we're going to pay a base tax of $113,900 plus 34% times any amount over $335,000. So in going back to our example, here's our base tax, $113,900, and then we're going to take 34% times the difference between our $8 million and the $335,000, which happens to be $7,665,000, multiplied by the marginal tax rate of 34%, leaves us paying $2,606,100. And so if we take this amount, add to it the base tax amount, this company is going to pay a total of $2.72 million in taxes on its $8 million of income. Fair, unfair, that's not for us to say. I just want you to be able to calculate this using the tax table. Now, you will be given, on the first test, you will be given a tax table that looks just like this, okay? So you don't have to worry about memorizing percentages or anything. You're going to have this exact table given to you. But is this calculation, is this making some sense in terms of, if I give you a tax table, give you a dollar amount, you can calculate income tax? Now, keep in mind that the table that you're looking at here, please, if you own a business, don't use this table to calculate your income tax. This is just a rough estimate of how much tax would you pay. You need more tax guidance than this. So don't take the, do this, turn it into the IRS and tell them your finance professor said, this is how you calculate taxes. This is just an estimate. But it's a pretty good estimate because it lets us see the income tax increase. So we could calculate, for example, a couple of different terms here. Average tax rate, that would be the taxes paid divided by your taxable income. And then the marginal tax rate, that's the tax that you pay on each additional dollar of income. And so we can see, if you go back and take a look at the tax table, if you fall, for example, within the 0 to, let's say you make $23,000. What percentage of your income are you going to make or pay on $23,000? 15%. What if you go from making $23,000 to making $23,001 of income? What percentage are you going to pay on that additional dollar of income? You're going to pay 15 cents per additional dollar of income, and you're going to pay that up to the $50,000 mark. Now, at the $50,001 mark, you're going to pay 25% additional on each dollar of income. So, whenever somebody says, for example, if they say, I'm in the 34% tax bracket, a lot of times we hear that and we think automatically, well, that means that person is paying 34% of everything they make in income tax. That's not correct, okay? They're paying, at this point, at the point that they reach $75,000, they're paying 34%, but up to that point, they're starting out at 15% for the first level, and then 25%, 34%, and you can see that it increases. So again, a lot of times we get some negative press about tax rates, and they'll say, well, the maximum tax rate is 40% or whatever it might be. Well, that doesn't mean you're paying 40% on every dollar you make. It just means you're working your way up to that 40% tax rate. All right, so taxes, let's see. All right, the rest of chapter 2, I'll just let you kind of take a look at yourself. But are there any questions to this point about chapter 2 before we jump in and talk for just a few minutes about chapter 3? All right, so now that I've got you excited with you're just on the edge of your seats talking about income tax, we're now going to switch to financial statements. So it's getting better, okay? So just hang with me here. It's getting better. The first couple of chapters, you'll notice, we really haven't done much in terms of calculations. And most people, when they think about a finance class, they think, wow, I'm going to be using my calculator all the time, calculating stuff. Well, starting here, that's kind of true, okay? We're going to do some calculations. You just need a basic calculator for chapter 3. Chapter 4 has a few calculations. It's really chapter 5, which is going to be the second test when we really get into a lot of number crunching, okay? So if you're the numbers person and you've been waiting for that, it's coming, okay? Don't give up on me. If you're not a numbers person and you're scared to death of that, well, get ready because it's coming, okay? But it's my job to make you, to walk you through that and get you through that successfully, so don't panic on me just yet. All right, now, so chapter 3, financial statement and ratio analysis. You've seen some of this before, okay? I know in other classes you've calculated financial ratios. So as we go through this, I'm not as necessarily worried about the numbers as I am you understanding what the numbers are telling you. That's the important thing about chapter 3. Now, and I'm going to jump ahead some of this. This is talking about generally accepted accounting principles. My accounting students in here, you're going to be more than well versed when it comes to GAAP and generally accepted accounting principles. So I'm not going to spend a lot of time talking about this. The Sarbanes-Oxley Act, this is one reason that we have so many accounting majors, is because it created a lot of accounting jobs because of the poor job that we had been doing previously in the accounting world. So basically, we went through, we redid everything. This is one result of the Enron fiasco. Enron is a company most of you have heard of in textbooks. You've studied it in your ethics classes. You've studied it in your business classes. It is the poster child for mismanagement of a corporation and what you're not supposed to do. Remember, back in chapter 1, we said a manager's goal is to maximize stockholder wealth or maximize stock price. The Enron fiasco was just the opposite of that. And that's kind of what woke a lot of people up and said, look, we're not doing things right. We're taking advantage of stockholders. A lot of things are happening that investors know nothing about. Let's open this up. Let's make it more transparent. And that is what happened here with the Sarbanes-Oxley Act. Okay, so let me jump ahead to the 4 financial statements that we're going to talk about in here. And we're primarily going to talk about 2 different financial statements, that being the income statement and the balance sheet. Now, here's the definition for the income statement. It says it provides a financial summary of a company's operating results during a specified period. It can be prepared quarterly, monthly, daily. Typically, we're going to look at it on an annual basis. But it generally just shows us what's the company been doing. How productive has the company been? And we'll take a look at an income statement pretty quickly. Now this is in your textbook. You'll notice there are 2 years worth of data here, 2014, 2015. And this is year-end data, December 31st. This income statement looks basically like most income statements. I mean, they all pretty much look alike. We start out with top line, sales. So sometimes it's just listed as sales, sometimes it's sales revenue, sometimes it's total sales, sometimes they just call it revenue, whatever. It's what they've sold. So whether it's physical goods, whether it's services, whatever, sales. Then we subtract out cost of goods sold. That leaves us with gross profits. Then we subtract out operating expenses. So we have to pay our employees, we have to pay our leases, we have depreciation expense, which we'll talk more about in chapter 4. That leaves us with operating profits. Then we subtract out interest expense, leaves us with net profit before taxes. We subtract out income tax, which we pay to the government, and that leaves us with net profit after taxes. Now, this particular company has 2 different types of stock. It has common stock, which we'll talk about in a minute, and it has preferred stock. So notice, and this is going to make more sense when we start working with these numbers, this company has net profit after taxes, which is typically the bottom line of the income statement. Okay, that's it, that's the bottom. But since this company has shares of preferred stock, it pays preferred stock dividends, and so it has something additional called earnings available for common stockholders. Now, you might want to make a note of this, but again, we'll talk more about this later. If a company does not have preferred stock, then earnings available for common stockholders is the same number as net profit after tax. But since this company does, there is a difference, and it's going to make a difference when we start working through the ratios as to if the company does have shares of preferred stock or not. And then we've got a couple of other ratios here, earnings per share and dividends per share. But again, this is primarily what an income statement looks like. Now, a lot of times with income statements, we think, well, okay, that's a corporation, that's a business. But you can actually have your own personal income statement. And I would actually strongly suggest getting in the habit of filling one of these out, maybe once a year, maybe twice a year, something like that, just to see where your money's going. So this is a personal financial example of an income statement. So you'll notice at the top, this particular couple, Jan and John Smith, they have income listed here. So they've got money from their jobs. They receive some interest income and some dividend income. So they've got $73,040. Then they have their annual expenses. So they make their house payment. They make their car payments, their utility payments on their house, home repairs, food, car expenses, insurance, taxes, etc. They subtract everything out. So they've got their total expenses here. And this company, once we subtract total expenses from total income, this couple has $11,336 left over that we call surplus. And with this surplus, this couple can do whatever they want. They can take a vacation. They can invest it. They can buy a new boat. They can do whatever they want with it. But what happens is a lot of times, and some of you may have experienced this, when you get paid, sometimes your paycheck doesn't last until your next paycheck. And you're wondering, where is my money going? What am I spending my money on? Well, that's not uncommon. So what I would suggest if that's happening to you is, for a month, write down every penny that you spend. If you spend 80 cents on a pack of gum, write it down at the end of the day. If you spend $6 on lunch, write it down. If you spend $12 on gas, write it down. Because what tends to happen is, for most of us, if we have a fairly large purchase, maybe $50, $100, we might think about that. We look at it and we think, okay, do we need it? Maybe we're in Walmart. Okay, Walmart takes all of our money. And so we're in Walmart and we're throwing stuff in your basket, you know, $1, $2, $4, $5, whatever. And we don't think anything about it. But then we come up to something that costs $50. And we're like, yeah, no, I don't know if I need that or not. I'll think about it a little bit. But what we don't realize is it's the small purchases of $5 or less that tend to add up. And that's where our money, that's the black hole into which our money disappears. But when we think back over it, we're thinking, well, yeah, I remember buying that big purchase, but I don't remember all of the small purchases. So again, if you do that, that's extremely helpful when it comes to figuring out where's your money going. Okay, so personal finance example here. The next financial statement is a balance sheet. Balance sheet's pretty straightforward. It says it presents a summary of a firm's financial position at a given point in time. So just like the name implies, it balances a company's assets with its liabilities and stockholders' equity. Assets, that's what the company owns. Liabilities, that's what it owes to other people or other companies. And then stockholders' equity, that is the part of the company that the stockholders have provided, okay, by typically purchasing common stock. So, balance sheet, pretty straightforward, assets and liabilities. This is what a balance sheet looks like. This is the asset portion. You'll notice here, we've got assets listed here, and it almost always starts this way. We start with the most liquid assets. So cash, that's as liquid as you can get. Marketable securities. Accounts receivable. What are accounts receivable? Somebody give me a simple definition. Okay, so accounts receivable, you sold something to somebody, they're supposed to pay you, and this company has, in 2015, they have these are in thousands, so they have $503,000 sitting out there that they haven't collected yet, but it's supposed to be paid to you. Then we have inventories. What's inventory? Okay, it's an asset. What does it consist of? Okay, so stuff on the shelf, the stuff that you sell. It could be, if I'm a textbook seller, inventory could be the 50,000 copies of this textbook I've got sitting on shelves. Okay, if I'm a chair manufacturer, my inventory could be these nice blue chairs, sitting in a back room somewhere. It could also be pieces of chairs. So it could be chair backs. I could have 1 million chair backs sitting somewhere, waiting to be put together. It could be the seats, it could be the legs, it could be whatever. So it can be completed items ready to sell. It can be pieces of completed items. And we'll talk more about that in a minute because it's really important regarding how easy or difficult inventory is to sell. So we've got current assets. These are short-term assets. We then have land and buildings. So these are longer-term assets. Machinery and equipment, furniture and fixtures, vehicles. For total gross fixed assets. Then we have something called accumulated depreciation. What is that? Accumulated depreciation.
The value over time,
Okay, so so if we have an asset, and we'll talk more about this in chapter 4, but we have an asset, that asset typically is going to lose value each year. Okay, so if we have a car, a truck, a building, I'm going to take a step back there on your example of land, because land typically doesn't depreciate unless it's something like a coal mine, a gold mine, an oil well, something like that. Then that does depreciate, but typically land doesn't depreciate. So for example, if I buy a building sitting on land, I have to break out the value of the building, and I can depreciate that, but I can't depreciate the value of the land it's sitting on, because at least technically it doesn't wear out, whereas the building will. Okay, so we've got accumulated depreciation, so we've got net fixed assets. This is also called the book value of the assets. It's what the assets are worth on your books. And then we have total assets, 3597. The next slide, these are liabilities. This is what the company owes. So we've got accounts payable. This is what you owe people. You bought something on credit and you owe them $382,000. We have notes payable. We have accruals. We've got some long-term debt. We have preferred stock, common stock, paid in capital in excess of par on common stock, and then retained earnings. Retained earnings is simply a company's savings account. That's all it is. So when we went from the income statement where we had earnings available for common stockholders, they can do two things with that, two things only. They can either pay it out to common stockholders in the form of dividends, or they can put it in the retained earnings account, which is their savings account. That's it. So they might use this money later. Then we've got common stockholders' equity, and notice that when we add liabilities plus stockholders' equity, it equals 3597, which matches our asset side of the balance sheet. So pretty straightforward, pretty simple. This is a personal balance sheet. Again, I would get in the habit of doing this at least once per year. This just lets you see what's happening in your financial life. And again, a lot of times we don't have any idea what's happening personally in our financial life. So you'll notice this couple on the left-hand side, they've got assets, it's what they own. They've got some cash, a little bit of cash, they've got a little bit of money in checking, they've got some money in savings, they've got some money market mutual funds, so they've got liquid assets. Then they've got stocks and bonds, mutual funds, retirement funds, etc., so investments. They have a house worth $120,000. They have cars, I'm guessing probably a couple of cars worth $14,000. Then they've got some household furnishings and some jewelry and artwork. So total personal property, total assets, $147,175. Now, on the right-hand side, this is what they owe other people. So this is going to offset their assets. So they owe some money on credit cards. They owe some money on utility bills, medical bills. They owe $92,000 on the house that's worth $120,000. They owe $4,250 on cars worth $14,000. They've got student loans, personal loans. So they've got liabilities of $105,755. Now, the difference between liabilities, if we subtract liabilities from assets, this is what's called your net worth. And this is a really important number. Because what this means is, this is essentially what you're worth. So if you hear somebody say that they're a millionaire, What that means is they have to have at least $1 million more in total assets as compared to total liabilities. Now, what if, for example, let's say that I go to my bank this afternoon and I take out a personal unsecured loan for $1 million and I ask them to deposit that into my checking account. So let's say that this checking account number says $1 million. A 1 and 6 zeros behind it. Pretty damn big number, okay? Pretty impressive. So can I say, once I'm showing that, I mean, I'll write it in there for you if you want me to, $1 million. Can I say now that I am a millionaire because I have $1 million in my checking account? What do you mean I can't? I just told you I've got $1 million sitting right there in my checking account. So what's your problem? What's my what? The liabilities. Oh, you mean the right-hand side? Ah, damn it, you're right. Okay, I forgot about that. Okay, so over here under liabilities, I've got to put personal loan $1 million, which doesn't sound so good now. So if I borrow $1 million, but I owe that $1 million back to the bank, how much did my net worth change? 0. This is why, and you'll learn this, a lot of you may have already seen this, okay, but if you work around money very long, what you learn is a lot of times people that look like they have the most money, they drive the nicest cars, they wear the nicest clothes. I'm not picking on you, okay? Nice clothes, but I'm not picking on you. But they wear the nicest clothes. They live in the biggest houses. They take the most expensive vacations. A lot of time, those people are barely keeping their head above water financially because they've got a lot over here on this side of the balance sheet, but they've got more over here. They owe everybody money. And so if you looked at their net worth might be very small. Their net worth might actually even be negative. They owe more than they own. Now, for college students, it's pretty common to have a negative net worth. You're supposed to have a negative net worth. But what happens is when you graduate and you start saving money and you start buying a house and whatever, then your assets increase. You're paying what you owe on the assets down. This side's getting smaller. This side is getting larger. And so if you did this, for example, once per year at the beginning of each year, what you should see each year is this number getting larger. If your net worth is not increasing each year, you probably want to take a close look at what you're doing financially. Now, it might not increase much, but it should increase some. And again, this is what, now, we talk about numbers like this, and so I don't want you to walk away from this thinking, well, if somebody doesn't have a large net worth, that means they're not a good person. That's not what I'm saying. I'm just simply saying that from a financial standpoint, this is what we use to determine the wealth of a person, their net worth. Okay, so personal finance example. Then we've got a statement of retained earnings we can look at really quickly. Nothing too complicated about this. It's simply for a corporation, it states how much they have at the beginning of the year, what goes out of that statement, what comes in, and then the remaining balance at the end of the year. Okay, so basically, again, just like a savings account. And then we have what's called a statement of cash flows. We're not going to spend a lot of time on statements of cash flows in here, but I do want you to know what it is, kind of what it looks like. Typically, corporations can have cash come in from 3 different areas. They can have it from operating activities, they can have it from financing activities, and they can have it from investment activities. So this particular company, if you take a look at their statement of cash flowing in and flowing out, they had $500,000 flow in from operations. They had, $347 flow out from investing activities, and they had 61 flow out from financing activities. So over a year's time, this company had a positive cash flow of $92,000. And again, remember we talked about in chapter 1, cash is king in finance. Cash is what you use to pay your employees with. Cash is what you invest with, that type of thing. That's what this is referring to, okay? So typically you want to see this number as a positive number overall. All right. Now, what we're going to do on Thursday is, if at all possible, if you could print out the slides for chapter 3, it's going to save you some writing, okay, as we go through here, because you'll notice what we're going to do. Let me jump up here. Is we're simply going to take the income statement and the balance sheet in chapter 3 in your book. We're going to have categories of ratios, for example, liquidity ratios, and there's 2 listed here, and we're just going to plow through each one of these ratios. And I'm going to ask for your help from this. So, for example, the current ratio equals current assets divided by current liabilities. I'm going to ask for your help with these numbers. You'll notice I don't have this worked out, so we're going to work these out in class. And we're going to talk more importantly about what do these tell us about the company. And we're just going to plow through chapter 3. So if you print these slides out, also if you bring your book, that's going to be helpful, and a calculator, then that's what we're going to do Thursday in class. All right, questions about chapter 2 or the first part of chapter 3 before I let you go for the day? All right, everybody have a great day. I will see you on Thursday.